We're now turning to emerging markets, an asset class that is often misunderstood, frequently underallocated, but yet absolutely critical in global portfolios. The Nedgroup Investments Global Emerging Markets Equity Fund is managed by NS Partners, and I'm very pleased to welcome Ian Beattie and Mike Mortimore joining me today. Welcome, guys.
Hey, Neil. Good to see you.
Hi, great to be here.
Great, and thanks so much for sharing your time with us today. So let's start by talking through performance first, please. And if you can please also outline how you're thinking about emerging markets more generally, just given all the geopolitical risk that we're experiencing in markets at the moment.
Sure. Well, we just finished a good quarter for us, outperforming the index by a couple of percent or more, which puts the 1 year into a good positive number as well, over 31%. Index is only up 29 because we did 2.3 on the quarter against an index that was slightly down. So pleased about that, making some gains again. I mean, what I would say is what we did is there are very few themes that are working globally at the moment, and the same is true more or less in emerging markets. So we've got AI hardware that is still in a very strong bull market, and we've got that. We've got some defense plays that are obviously doing well, but it's noticeable they're doing better where we have them, which is in South Korea and to a certain extent in India, rather than in perhaps in the developed markets where we've seen some people take some profits more. And we've got renewables. There's obviously an oil crisis going on. We think renewables will be a big beneficiary of that. So that's worked for us as well. For us, renewables really are batteries and storage in general, but also BYD has done well for us. And in the auto side, very strong EV play, and cattle on the battery side. So yeah, generally we're really positive about that. What we did earlier this year is add to our oil exposure when we started getting worried about the situation in the Middle East. I think long term, I personally am still quite bearish on oil and also gas, but I think we didn't want to get hurt by being right on a 5 to 10 year view, but wrong on a 6-month view. So we got overweight oil pretty quick, bought some selective names, bought some big index names, but also some really high quality names as well, like Vista in Argentina. So we bought those, made sure we were the right side of that pain trade, I think, and that sort of saved us, I think, in that period of volatility. So we had a good first 2 months, and then in the third month in the quarter, we didn't give up much when markets came rattling back with the war worries, partly because I think we stuck to what I think are the sort of more secular themes, the AI hardware, the defense, the renewables, some value up in Korea and so on, kept our macro allocation tight, kept our risk control tight, but disciplined. And then just where we were nervous of oil price rising, for instance, we just covered that off, made sure that didn't undermine us elsewhere. So overall, quite pleased. I'm the sort of person who always thinks we can do better, but overall, yeah, that's okay. If we can push on again for the rest of the year as well now, we'll be very pleased.
Thanks, Ian. Yeah, I mean, I definitely know many times you always wish you could have done better, even though you've done spectacularly well. I think the quarterly results definitely show it. You mentioned about Vista. I definitely do want to talk about some of your trades a bit later on, but first, perhaps if we can just do a bit of a deep dive into what contributed to the outperformance over the quarter.
Yeah, so over the quarter, really, the performance on a relative basis is dominated by the great performance in Korea and Taiwan. And then really on the energy side, we just made sure that we didn't get hurt, adding enough there to the likes of PetroChina, Vista, Petrobras, so a mixture of big index names and high quality upstream oil there as well. But really the heavy lifting was in those AI hardware names, the value up in Korea. So, good old TSMC doing well, but also we've got a number of more niche specialist AI hardware names in Taiwan. and Korea that are doing very well. The semiconductors, the Samsung Electronics, the Hynix is doing very, very well, but also there's stocks that are derivatives on those as well, and are also benefiting from some value up improvements in corporate governance, like SK Hynix and Samsung C&T. They've been volatile, but we're making sure that we're keeping our discipline and keeping exposure to those, which I think we can do when we're keeping the overall risk control quite tight.
It was almost a game of two halves, and those names did a lot of heavy lifting in January, February, but then we were able to hold on to that relative outperformances as some of those oil names started to pick up through the volatility. So you did see some degrossing in some of those tech names through March, but if we bring it to today, as of the date of recording, those names have picked back up, which is positive. But a name like Vista, I think, we wanted to pick up that oil exposure, but I think as a team we need to love that stock if we want to lift the exposure to oil. So Vista, really low lifting costs, got a great growing production profile, but critically I think it's outside the Gulf. It's not going to be disturbed by questions over whether ships can get through the Strait of Hormuz or what have you. So you'll see that all the exposure that we've picked up is outside of that region.
It's very interesting to see the Saudis doing okay in all this, but the other Gulf countries are doing very poorly. That tells you, I think, a lot. So longer term, we need to look very carefully at those Gulf states and see how they rebuild after this. But let's wait until we see some clarity on the Middle East situation first. As Mike said, when you've got extreme positioning and degrossing for hedge funds and short-term players, you've got retail getting scared out and then wanting to come back in again into other parts of the market. Knowing where the various players have exposure and who's going to be under stress really helps us in our short-term tactical adjustments. So, for instance, we might like a stock in the long run, but if you know that there's a big fund manager out there getting redemptions, or a hedge fund that's being forced to sell its longs and buy its shorts, then that's an important part of how and when you adjust your portfolio. And that is always very important to us.
That was the catalyst for the oil discussion as well. We knew that it was a consensus underweight for managers.
Yeah.
And that was making us nervous. And it was a catalyst for having that discussion and then saying, okay, well, should we be devoting some of that risk budget to that part of the portfolio, given that we know that everybody's underweight oil? We weren't predicting a crisis that we've had, but we built up. We didn't have foresight of what was going to happen in the Gulf, but we built up that exposure right up to the end of Feb, where we were underweight and then subsequently went overweight.
We kind of knew which way the risk was going to move, if it was going to move. In that, as you say, where the positioning is, which is very underweight, as Mike said, and you could see the troops massing and ships being put in position. So there was a risk. We just thought that value, if you think about it in the value of an option, was underpriced. We do analyze political risk, both for every country and globally. It's not something we just sort of sit around and have a guess at later on. It is part of our process. And so we were, very keen on, as we do, always have done doing emerging markets. It's important for us to see that rising political temperature. Now, of course, I think it's in a lot of prices. We can still argue that there's a lot of disruption in that energy market to go and to work its way through the system. But I think I'm sort of more wondering now, how long do we want this energy overweight to be on the portfolio for? When do we go back to our long-term strategic view? I don't think there's a rush, but that's the thought process now. When do we go back to our long-term strategic position? A bit like we didn't want to get shaken out of our semiconductor position earlier this year when the hedge funds were degrossing, when retail was getting scared. We did reduce our exposure, but we're always looking for opportunities to add back to keep that longer-term positioning. And that's what this game is about, right? Matching conviction with your capital. So risk-adjusted returns is what we're all about, and therefore you need to take into account the risk, the conviction in your forecast, and then knowing how other people are positioned helps you interpret that on timing.
Thanks, Ian. Yeah, I really like those comments. And I mean, some things you've alluded to already in terms of your trades. Any further comments on that, please, before we move on? I think just given the volatility that we've seen, it obviously does present opportunities. And sometimes kind of good investments become fully priced as well. So kind of do a bit of proper taking there. Any comments on that, please?
Yeah, I suppose we still see some upside. The main one where we might be a bit different from others is we still saw a lot of upside in the semiconductor names. So despite the volatility, despite the noise and degrossing, really want to hold those positions and look for opportunities in that. And Delta did very well for us in Q1. We did take some profit on Heron and add to it. Vista Energy did its job very, very quickly, as did some other adding to on the energy side. Are underweight in a number of countries were as well. So underweight China, underweight India, zero weight Indonesia, all worked really well for it and gave us the sort of capital to deploy in our overweights in places like South Korea, in energy. The two raw materials names did very well, but also that IP exposure. I think the markets have been so narrow, you don't have these winners. On the stocks wise, we've got BYD, we've got cattle. I'm really pleased with how they're performing. It's not just about AI, but another factor in Korea in particular is the value up. There's huge corporate governance improvements going on in Korea, improving shareholder return. And of course, because of the chip boom due to AI, there is huge cash flow into Korea, into the likes of Samsung and Hynix. It's absolutely enormous cash that's pouring into these economies and into these companies. So it's going to be very interesting to see how that's distributed. We are seeing these companies and meeting with them and obviously putting forward where we want the money to go. I'm sure the Korean government is going to have an interest as well.
The operating profits are so massive. They're now second and fourth largest by operating profit in the world. So you've got Nvidia at the top, then you've got Samsung, Aramco, and then SK Hynix, which is we find pretty mind-blowing.
Yeah, so as well as Vista Energy, to cover that energy underweight I mentioned, we also added to Petrobras and PetroChina. I think it's fairly clear what we're doing there. You could think of that as a defensive mode for PetroChina. We also added ASE Technology and China Construction Bank, just rounding out that portfolio. That's more of a portfolio construction. I think China is bottoming out. We are going to see some improvements there in that economy, and we just wanted to round out that portfolio construction. On the sell side, we took some profits in Acton Technology. It's been a fantastic performer. MediaTek again. MediaTek has been a real good rotation winner over the last few months, and we've taken profit in that. I think the share price just moved a little bit ahead of itself. And we also rotated out of the financials in PICC, P&C, which has done very well for us over the last few years. We also sold Chifeng Geelong Gold in China. There's been corporate actions there. I think its rival, which we also own, Zijin, is kind of taking over the company in part rather than taking it out in one go and paying us the full whack. So we've exited that and going to move on elsewhere.
Might also be worth mentioning, just because we were talking at the end of last year about how we've been selectively building up our commodities exposure. So copper, gold, oil. We've actually started to pull some of that copper weighting back. We can probably talk about it in the outlook, just getting a little bit more defensive. The global backdrop economically is starting to weaken. So you can see us there starting to reduce exposure in commodities as well.
Yeah, it's a very good point, Mike, because we are still a little bit nervous on the global economy. This oil price shock, we think, definitely hits aggregate demand. It's going to hit the global economy. Whether it becomes inflationary is up to the central banks, but it's definitely a hit to the economies of the world, and therefore other commodities we're probably a little bit less positive on than we were, and we were always quite cautious at this end of the cycle, probably compared to others. We are still involved. Obviously, can understand how copper looks good in the longer term as we switch to renewables and electrification, but let's just see how this plays out. We're just being a little bit cautious there. That's not where we want to spend our risk appetite just at this moment in time with these questions on the global economy.
Thank you. And I guess just if we now shift to, let's call it the structural shifts in technology and AI, in which areas do we see emerging markets typically benefiting from that, and how do we take advantage of it?
Yeah, well, I think you can really see the markets are telling us at the moment that Korea and Taiwan are huge winners. They make the chips, they've got the foundries, and they got the chips that the AI boom is consuming massively. How long this will run for? Well, that's a question about supply and capex demands and the appetite for financing that. But at the moment, it seems the market is telling us that it is a clearer and easier story than maybe playing the Mag 7 in the US, and we'd go along with that. How long we'll run that for? Let's see how hard and how fast it runs. But it's certainly very important, and the market is very clear that that's the answer. All our bottom-up work suggests that there's still lots of upgrades to go. How long and how fast that gets into prices is the key question, but we're still riding it at this moment in time, and making sure that our exposure is tight and risk controlled, but still focused on those areas. We're not taking much risk in some other areas at the moment as a result, so to afford that risk taking there. Fascinating contrast in approach between China and the US, and they're the only regions that matter here. Everybody else is still way behind. Yes, there is some good activity going on in London, but with DeepMind, but that's about it. So the US obviously chasing the high end, both in terms of the way the models are working, and the technological hardware to supply it. China very much going more open source, keeping it more of a lower cost. Both of these have their reasons. It's going to be fascinating to see it play out. I'm not really in the mood to pick one over the other. They are the realities that we are investing with and that we're getting on with. So I'm not going to be somebody saying, oh, China's right or the US is right. This is going to be fascinating to see how this plays out, and we're going to play both. What is important is we have to have the power. As I've said many times, and I know we've said this in many conversations, AI is incredibly power hungry. Everybody's doing their best to kind of reduce this, but in the meantime, we need more power. And China's very good at getting that on stream, and you can see that other governments are trying to catch up here on getting their power supply back. It's going to be thermal, it's going to be renewable, it's going to be everything: solar, wind, nuclear, hydro. You're going to need everything.
So there are some amazing numbers coming out of in China. Just their advantages, they don't have access to the leading edge chips like the US. The compute power in the US is it's in the order of something like 10 times what China has access to right now. So for China, it's about using basically abundant, nearly free energy. Last year, they brought 500 gigawatts of power online, which is, just to give you some sense of the scale, that's more than the rest of the world combined and 10 times what the US added last year. So for US, the risk is that you have access to leading edge chips, but you might not be able to turn them on because you don't have access to the power. And Microsoft have actually come out and said that this is a real problem. Whereas China, they don't have that problem. And the plan there is to, without the access to the efficient chips, they'll build bigger data centers with less efficient chips and use the energy advantage that they have. So, we've got some really interesting charts here on you can see the power, the energy that China is adding to the grid. They also have a very modern grid as well and have made investments in that. So, and it's going to have to happen in the US and outside of China too. So we're playing those things as well. So these are crucial bottlenecks in the chips and in the energy respectively.
And energy is a really big one. We were playing cooling to try and keep these chips cool because they generate so much heat. It's a thinking machine, right? And our brains, just like an AI computer, requires a lot of calories and it gets hot. That's the same for biology as well as it is for the physics of these machines. So we've been playing the cooling, now we're playing the energy as well, whether that's renewables, whether that's uranium and nuclear, the lot. We're going to follow all these solutions, I think, as is the industry.
Okay, thanks, guys. I guess to end off then, what can we expect from the macro and liquidity environment going forward, and what would you say are the implications for portfolio positioning?
I think for the whole of the world, we take a step back and look at the whole global situation. We're a little bit nervous about the global economy. Excess money growth is fading. we're at the top of the stock building cycle, which has already peaked and start to enter an unfavorable phase. And then we've got a Gulf War going on as well, and hitting the supply chains and energy. Obviously, it depends on how quickly that is resolved and what the central bank's response to that is. Do they take the hit in the economy, or do they allow some inflation? This is what we've got to watch. You can't predict that. You have to wait and see how that data changes and how those central banks respond. But it's not something we're particularly bullish on at the moment. And any bounce post the resolution of the Middle East situation, you'd probably see us take some profits on some of those more globally cyclically sensitive areas. However, emerging markets looks in much better shape. As we've said before, there's less debt. The dollar should have been strong in this crisis. The fact that the dollar is weak makes us much more positive on emerging markets. Something is changing. You often, when you get a major sudden shock like this to markets, the markets sometimes give you a hint about who the new leadership is going to move to. And the fact that the dollar is weak in all this is telling me it might not be the dollar, although I wouldn't want to push that too far, but it's just a little hint about what's to come, and does make us more constructive on emerging markets. China is on a slightly different cycle. They've had their slowdown. They've had their very long, protracted slowdown, and it looks like it's bottoming. There are signs of life even in the property market. The consumer maybe has bottomed out and just slowly, tentatively starting to recover. There is lots to do. We're not banging the table saying we're bullish, but it looks like it's starting to look a little bit better. And Northeast Asia, China, Korea, Taiwan, even Japan, look so cheap. Their currencies look so cheap. So that is something you want to be positioned in, I think, that whole area. And China, consumer confidence starting to recover. Is the government going to lean into it? Could turn out to be a very interesting multi-year story turning out there. There's still lots to do. I'm not saying we're seeing a restructuring and the great rebalancing that all the pundits like to talk about, but this could happen. We need to see if it starts.
So this is the shift from the exporters driving economic growth more towards consumers.
It's possible.
We've talked about for a long time, but we haven't seen any concrete measures really come through yet.
All the talking heads have been talking about it for a while. It's actually, because of the currency is so cheap, it's been all one way. It's the exporters that have done well, hence our names like BYD in the portfolio, which is actually in there for an export story rather than a domestic story. But we're just watching to see if this domestic story starts to happen. We're not really sure yet, but this is the time when it could happen. So PMIs look better in Asia. The exchange rates are cheaper in Asia. So we're probably still going to bias to those countries within emerging markets. And EM looks better than DM, I think, at the moment as well, as long as there's no major conflagration, as long as it doesn't worsen in the Middle East, okay, which is a big if. But as we work our way through this, and the sides are talking now, blockades on blockades, kind of is quite an interesting development. We could see that. In the meantime, we've got our defense plays. I think even the Middle East and the US are even buying from the Koreans now. India defense spending looks well set. We've got some other secular themes in there as well. So yeah, we're in summary, we're worrying about the real economy. We're still playing AI. We're still playing defense. We're still playing renewables. I think renewables will get another kick from the oil crisis. Oil prices where they are really helps renewables, really helps solar, really helps EVs. The PMIs still look okay in Asia. Money supply looks better in Asia. Currencies look really cheap. I think it looks really good. If you get the great rebalancing in China, then we're talking a multi-year bull market. But let's just say we're looking out for that rather than expecting that just yet.
Okay, Ian and Mike, brilliant. Thank you so much for your time. Really appreciate all of your insights.
Thank you very much, Neil.
Thanks.
See you.
Thanks for joining us. Bye-bye.